I know, here's second video on the practice exam. I'm going to try and go through these a little quicker if I can, because again, you can stop me, you can replay me, etc. So this is an equipment exchange. There's a couple of good things on this. One, it goes through disposal. So how do you dispose of an asset? So what are we doing? Prepare the required entries, sorry about the phone, to record the exchange assuming A, the transaction has commercial substance, and B, it does not have commercial substance. So sorry if I don't check my phone really quick, it's just going to keep buzzing every minute, so I'm too lazy to edit the video. So again, if it has commercial substance, it means it affects cash flows. Regardless of whether I'm doing commercial or non-commercial, I need to get rid of this asset. And it's 2 delivery trucks on my books for $110,000, fully depreciated. So what's in the accumulated depreciation account? Well, it's $110,000. So the wording there is a little different than what we're used to, but we should know what that means. And I need to get the cost off my books. What are they? Trucks? PP&E would work, assets would work. And then if there's commercial substance, I'm going to record this new asset, this equipment, at fair value, and the question does tell me that the equipment's worth 19 grand. And the difference is my gain. Again, gain on whatever you want to call it. Gain on truck exchange, gain on a equipment purchase. Okay? So that's part 1. Part 2 says, well, what if there's no commercial substance? And if there's no commercial substance, all that means is I can't record the gain. So I still have to get rid of these trucks, right? They still have to go away. And then if there's no commercial substance, the rule is the new equipment, or what I'm acquiring, comes on at the book value of what I gave up, which in this case is 0. So truthfully, I wouldn't even need this line, but I might want to put it in just to know I have a piece of equipment even though it's got $0. Okay, so I think the key thing is to get out of that. That's always your starting point when you record a disposal. We didn't have cash in this one. If we had cash, we would have thrown that in, and then we can record our gain if it's got commercial substance and not if it doesn't. Question 3. Bought some equipment Jan 1, 2011, $4 million. Straight line basis, 20 years over with no residual. And we're using the revaluation model, and we revalued at the end of 2012. So assuming the entry for 2011-2012 depreciation has already been recorded, prepare the entries to record the revaluation adjustment. So again, step 1 is make sure depreciation is recorded up to the date of the revaluation. In this case, it is, so I don't need to worry about recording depreciation. So what do I need to record? Well, the steps I follow is, first off, zero out the accumulated depreciation and move it to PP&E. So I want to debit accumulated depreciation because it's got a credit in it. How much is in there? Well, I've got a $4 million asset. I can just stick this in anywhere. It's equal to the $4 million asset divided by 20 years. Check your dates just to make sure, but this was bought on January 1st, so I want to record depreciation, or depreciation's been recorded for 2011 and 2012. So I could do a T account and show 200,000 a year. Here I'm just trying to kind of be lazy and quick. But I've got 400,000 sitting in my accumulated depreciation account. I want it to go away, and I'm going to move it to my PP&E account. So I'm going to call it equipment. I'd be happy if you just called it PP&E. Okay, and then step 2 is adjust the PP&E to fair value. And I guess here we'll do a quick little T account. I initially put 4 million in here. When I did the first part of the revaluation adjustment, I took put a $400,000 credit in. I need to get the balance. To the fair value, which is 4.1 million. So what do I need to make that work? Well, it looks to me like I need 500,000. Right, 4 million minus 400 plus 500 gives me 4.1. So debit equipment, 500,000, and this credit is that revaluation surplus account. And please get this account title. That I'm going to be pretty sticky on. It's a weird account. Okay, that's it. The other thing we might occasionally ask in these questions, and I didn't hear, is how much depreciation to record in 2013. So if I was asked that, well, it's going to be the 4.1 million divided by how many years of life I have left, which is 18, right? I had a 20-year asset 2 years ago, so it's going to be 227. Good. What's question 4? Oh, that's a short one too. I will do it on this video. This is just a present value. Bought a truck, issued a 40,000 1-year non-interest bearing note. So anything that's non-interest bearing of a year or more, you need to present value. So the present value of 40,000, and I've got the calculator numbers posted on the other video. And if you go through, it is 36,364 rounded. So that's what my truck is worth. Truck. Right? It's not 40,000, it's the present value of 40,000, and I've got a note payable. And it says journal entry to record the purchase, so that's that. And then the payment, so 1 year from now, I need to accrue interest. I'm going to do this as 2 separate entries because that's how I've usually done it in class, but it could just as easily be done in one. It's going to be 36,364 times my 10% rate. Again, don't get hung up on rounding. I think I'm a part dollar out. And I'm going to pay the note, which is, I did the calculation, $40,000, and that's cash. Okay, so be able to do simple present value calculations. Realize you have to do a present value calculation if it's non-interest bearing and a year or more in length. And yeah, record your interest over time. Watch the months. I mean, this was easy in that we didn't have a year end or any accruals, but that would be fair game as well. And that's question 4. I'm going to drop this video here, and then I will do another one for the last 3 questions. Thanks all.